Hello, and welcome to your market update for the week of January 24th, 2022 with Legacy Wealth Management. In today's podcast, Pete Covino, Andy Rad, and Caleb Howard discuss what it means to go risk off in our portfolio management and how Legacy Wealth navigates the waters of tumultuous markets. Please note that this video is for educational purposes only. The information discussed in this podcast should not be taken as advice or a guarantee of results. Thank you for watching. Now let's get to the show.
Got it. Thanks, Taylor. So yeah, happy to be here today with Caleb and Andy, part of our investment committee. And typically we meet about twice a week as a minimum to discuss what moves we might be making and what decisions we're making for our clients' accounts. And so today is sort of timely because as we sit here, as a firm, we've been risk off, and I'll explain what that means later, or we'll talk about that a little bit, since December 3rd. And since December 3rd, a lot's gone on in the market, but generally it's been down. Our thought is that we would discuss this today. For example, this morning I got an email from a new client, and she said, Pete, worried about what's going on in the market, would really be interested in hearing your thoughts. And I get these emails from newer clients and newer relationships, but one of the things in our mission statement, or at least it used to be in our mission statement, was we're really focused on helping our clients sleep at night. So today we wanted to kind of get something out to our clients. Of course, they'll send this out to some of their friends, I'm guessing, but the message that our firm, I think, brings to the table and what we've demonstrated in our active style of management is relevant, particularly on days like today where the market was down, I think, 3% at one time, and then it finished up a little bit. So you see this extreme amount of volatility. You see this general trend down, a lot of fear out there that's starting to creep in, different geopolitical stresses. And so we talk about these things in our weekly meetings, but more importantly, we try to make decisions that enhance our ability to mitigate risk for our clients. And we do that in a number of ways. And today we thought we would share some of those ways. Does that sound good to you guys?
Yep.
Okay, so to get in a little bit, Caleb actually is the one that sits on the trade desks and watches these accounts on a daily basis and watch what's going on. Today we thought we would talk about a couple of our strategies or techniques that have more exposure to the market typically. So we have this strategy called Pure Alpha. Our clients that have Black Diamond would see this in their Black Diamond report as a separate strategy. People that look on their TD accounts just see these positions, and we watch them and they see activity going on, but they don't always know what it is. So this is good to kind of bring to light what it is that we're doing for them. So describe, Caleb and Andy, what it means when we say we're risk off. Kind of talk about, Caleb, why don't you talk about what that means, and then Andy, how did we determine that was what we do? What's the story behind how we made that determination and who influences us on that?
Sure. So risk off in our strategy, and typically when you hear risk off in finance in general, is that you have exited the market. You have taken the risk out of your portfolio in stocks, and you have moved them oftentimes into cash or treasury positions. Sometimes it might mean that you go into fixed income positions like maybe bonds or things like that. But for us, it typically, when we are risk off, we leave the stock market and we go into treasuries. At this point, we are very short-term treasuries, but government-issued treasuries is what we're in for the most part. And we have been since December 3rd in the specific strategy you're talking about, Pure Alpha.
Has it influenced any of our other strategies? I know last time we went risk off, we really went risk off with across the board on our active strategies.
Right. So we have a couple active strategies that it influences directly. We have a couple that are really minimum low-level entry points that we call our $0 strategies, and across the board, it definitely influenced them directly. We have another strategy that we call tactical income, which is very much a tactical play. So this type of idea fits exactly into that strategy and what we're looking to do. We were already pretty conservative as far as that strategy goes at the time, but definitely going risk off helped affirm some of our beliefs already, and also just continued our plans going forward. It kept us from going more risk on as the year turned over, as lots of people did.
Andy, when we first brought you on as an investor, and then later as you got into the industry, I'm going back a decade now, we started looking at several different money managers. And one of the things that appealed to us coming off of the 2009 market crash was these guys that were really tactical. They would move around and try to, we kind of use these analogies like think of sailing. If you're sailing, you just put the wind up, and if the wind's at your back, boy, you're heading off into the sunset. But if you get headwinds, you're in trouble, and you'd rather be rowing and navigating that way. And so we've been in a bull market, and sailing has been really ideal, actually. If you just sat in the S&P 500 for the last 12 years, it's been really attractive. In this type of market, you see people starting to get real more interested in a tactical nature to be able to navigate it. So we utilize a little bit of both of those, which actually statistically is favorable when trying to minimize overall risk. But Andy, talk about and describe how we go about, with deciding to go in or out of the market or less risk on.
One of the things we do is we subscribe to numerous newsletters, which kind of give an overview of where the different profits are, earnings, what we should expect, geopolitical issues, and so on. So we take that as one side. And then we have a couple of strategists that we get signals from. And then we will evaluate those three together and make a determination. So when our strategists that we get our outside signals from start to go risk off, we will start implementing. And usually it'll first be in our alpha, the one that Pete mentioned earlier, which is primarily stocks that are tied. Those are going to be similar to the S&P type. And then as we get more and more into a risk-off environment, we'll start moving that over to tactical income and any of the other strategies we might have out there. So, and I know oftentimes clients are thinking, well, I need to have this 60-40 bond split. Well, bonds are no place to be, so that's not an area. So we really do need to go into something short-term and try to mitigate that risk. So said, this is in the last probably 9 months, 6 months. This is the second time we've gone risk off. And this has been the right move in both times. I know as soon as we went risk off in December, it was beneficial. And then the market started turning around, but we still were ahead. And now with this last round of what has been happening, we are definitely protecting on the downside what's going on here. So, there's always a chance of getting whipsawed, but this is where trying to get numerous strategists, some of them with different algorithms they're using to determine this, and then reading the different subscriptions we have helps us to get a direction where we're going so we can navigate this.
Yeah, I think this is a good time to point this out. You think of our overall portfolio, and if you think, okay, here's 100% of your money, Mr. Client. When you look at what we're talking about today, the tactical piece, the stock market exposure, you're probably talking about maybe 20% of their portfolio, maybe 40 at the most, depending on the size of the client. Sometimes clients come to us specifically to protect against downside risk, keep them out of the volatility and the crazy things that go on in the markets. And so they're already going to have pretty limited exposure. Now, on the other hand, there's clients that really love the stock market. They believe long-term it's the place to be. It's a great inflation hedge. All of those philosophies work. What we do is bring it together, create the right recipe, and I always use that analogy when I'm talking to clients. And what I think is kind of profound about what we've done right now is again, we're just talking about this one little sliver. So if you think of 20% of the money in this tactical nature, it's easy to pat ourselves on the back and say, this time we're risk off, things are looking good, we look like heroes. We're probably ahead of the market as of right now, 12%, wouldn't you say, Caleb?
Yeah, potentially. The market down and since December 3rd. I looked this morning. Now the market's moved a little bit since I looked, but it was about 12%. The market was down since December 3rd.
That's a nice position to be in. But even with that, it's, you're out of this craziness, and clients don't have to think about it and worry about it. And of course, it's beneficial to miss the market when it's going down. On the other hand, we have other positions in our clients' accounts where they do have market exposure, but it's much more selective, or we've built in this enormous amount of downside protection. I'm thinking of the last note we did with Tesla and Diamondback Securities and Intellia. That is a note that we built here in-house. It's paying 29% a year, and yet it has enormous protection. I saw Tesla. I have a brother that just bought, I don't know how many hundreds of thousands of dollars to Tesla, just thinking that was the best place to be in the future. And I don't disagree with him. It may be, but it just isn't a smart way to invest in it, right?
Yeah, I think to use some financial terms, what you're kind of getting at with the whole 100% of the pie picture is that we're looking to diversify the risk in a number of ways.
Yeah.
And what we're talking about right now specifically is just the part that we do have exposed to U.S. stock marketplace.
Yeah, exactly.
And it's not. It's definitely not across the board. For example, we own in one of our strategies Exxon Mobil. Exxon, we did not go risk off on. We actually stayed the course, and as oil prices have gone up, and Exxon's supposed to have its numbers out on Wednesday, and they're expected at this point to exceed expectations. Now we'll see if they do, but it's right now. So that doesn't mean that we're leaving every stock in our portfolio, but the majority of our stock, the section of that client's portfolio that is exposed specifically to, in this case, large cap U.S. stocks,
and
was where we went
specifically
risk off.
sectors such as technology.
Yep, we had some.
Internet.
To talk on your point of this goes across our firm wide. We had some technology exposure that we took off through, I think, a couple different positions that we held in our clients' accounts, and they both went risk off at the same time. We also, around the same time, left bonds because of the rises in interest rates. And I'm assuming. Actually, I'm not assuming. I know that some of the interest rate scares were part of the reason why the risk off happened as well.
Sure. Yeah, Andy, what other thoughts do you have on how a client should be thinking about our approach to managing risk?
Well, I would say that we're looking at rebalancing again tomorrow and looking at things. We'll see if the signals change, which typically it's the end of month or end of week. But as we get different signals coming in, we will tiptoe back in. And if there's a lot of volatility like this, we're also constantly building notes, and the higher the volatility, the greater returns we get on the notes. So this is an advantageous time for us when we start building notes. I go back to December 2019 when we were doing notes, and some of those notes on the broad indices are bringing us mid sixes. And as soon as you started getting volatility, you're going up into the 8 and 9%. So the volatility is your friend if you know how to harness it. And I'd say that's what we're working on here, is to use that as a tailwind to help us by having this volatility in there.
Yeah. What kind of exposure do you personally have to notes? And again, when we talk about notes, I know this segment isn't meant to be about the notes, but I think, again, clients want to understand how are we navigating this downside. And Andy just brought up a great point. It's like, look, these type of markets, I sent this back to the email on the client I was referring to earlier. This is really where a firm like ours thrives, because we're watching for volatility. We're watching, like when we go risk off, we're seeing what's going on in the market. That could be a great time to re-enter. We're not trying to catch a falling knife or try to pinpoint when the markets are going to bottom out. There's no science in that. These things go up, these things go down. We're looking more at the economics and the science components to what it is. And Andy's point, we're getting way better what I would call multiples or offerings when we build these notes. So again, we'll have another segment on that. But go ahead.
I think that might be a segment that we record in the next 2 weeks or so, to make sure that we're really educating on structured notes. But you're right; it plays into the active management. It plays into the role of what we're doing when volatility increases. We've seen huge annualized returns just on some really short plays and structured notes. When we saw that volatility get up into the mid 80s. Back in the COVID crash, as they're calling it, we were seeing some annualized returns over 300%. We just exited that one specifically that was tied to energy. That was, I think, an annualized return of about 75% after we got out of it. And we couldn't have done either of those things without the volatility. Now, that energy one was both volatility from the stock market and volatility from that oil crash that happened at the same time. But the other one that I was referencing earlier that we had over a 300 annualized return was straight stock market exposure through a structured note. Yeah. And we obviously would not have been able to have that same exposure through volatility. We wouldn't have been able to have that same exposure if we hadn't been a firm that already utilized structured notes and that type of stuff. Yeah.
Well, before we wrap up this particular segment, I wanted to talk about one little piece that Andy, and I think you just touched on, Caleb, and that's the rebalancing component and taking advantage of what lies out there right now. And so, we sit here and we talk about it, and when I look at my clients' accounts today, I'm feeling like a hero for sure. But that's not to say that we don't have positions that are in the accounts that are down. So let me just talk about a couple of those for a second, and then segue into how we position ourselves to take advantage of those that are down and what we think of, how we think of those. So, for example, Caleb, you were talking about ExxonMobil. Mm-hmm. We've held on to it through this whole thing. We've got a nice dividend, and it's actually gone up while the markets have gone down. Of course, oil's gone up. So part of this is us thinking about inflation hedge, how profitable is an energy company when oil prices are this high, and that paid off really nicely for us. On the other hand, thinking about positions like Coinbase, Bitcoin, Ethereum, where we've been absolutely crushed. And they're actually a significant part of another one of our strategies. That strategy, though, has been sitting in cash for the majority of it. So it's got a little exposure to that part that's been crushed. So now talk about what we do in terms of a discipline to have the, to go ahead and start to move back into these things while they're down, and if that makes sense.
Yeah, so, I mean, we've been talking about active management the whole time, which essentially just active management itself is changing an allocation based off of either upcoming market movements that we're projecting or reacting to market movements. The case you're talking about specifically is reacting to a market movement. When we have really any stake, but this scenario specifically cryptocurrency exposure at a decently high stake in that strategy. I think all in between our multiple plays, we're at about 25% of that strategy, and it has a big drawdown like this. What we look to do is we rebalance, to use the term we've been using, back into those positions. So what that means is our positions that have either been positive through this experience, whether that's an ExxonMobil or a Diamondback Energy or something like that, and we sell out of that and we move more into this cryptocurrency. We also do it across strategies. And so what we're able to do is we have a strategy called preservation that's only been down through this whole 12% market drawdown, about a percentage. And so we're able to take money out of that position as well and move it over into that strategy you were talking about that holds the cryptocurrencies and increase our exposure to those cryptocurrencies to take advantage of that drawdown. Now, lots of people say, well, what happens if the price keeps going down? Well, it's pretty simple. We still have a huge portion of money that's in safe positions. Yeah. We just take a little bit more in, and we go again, and we bring our cost basis down every single time we do that. And then when cryptocurrencies rebound, Bitcoin gets back up to $80,000. You know what we do?
Right.
Do it again, but this time we're selling cryptocurrency, not buying cryptocurrency. Yeah. And it's this constant active exchange of, hey, this is done well, let's take some money out of it, go over here to something that's done bad, and vice versa over and over and over again.
It's worked out really well for us. It's nice to see that our strategies and the overall portfolio construction is being effective. It's working to the way that we describe to clients. This is the type of market that really puts us to the test, right? This is enough to say, okay, how did you do? I'll end on this note, and whatever you guys want to add to it is when we look back, clients will ask questions like, how did you do in 2009? How did you do during the tech bubble? And a lot of our reps weren't even around back then, but we can talk about that. And then the most recent one, of course, is COVID. How did you do from February 21st to March 23rd? The market, the S&P's down 34%. And we can literally pull up clients' accounts and show them not only were you only down 3%, 5%, I think some cases we had some double digits, 11, 12, but for the most part, the range of our larger accounts that have full exposure to everything that we bring to the table, they were down but probably 3 to 7% on average. I mean, at least I remember seeing at least 50 different client accounts in that range. And so we're able to go back, like you just said, Caleb, and look at the last since December 3rd, and I can look at the accounts and I can say, wow, you're actually, it's ironic. This is going to sound too good to be true, but the accounts that I'm looking at right now are actually positive. Now, part of that's because of other things going on in the portfolio, so to be continued. Stick around for our next segment on some of the alternative investments you use in private equity and real estate. But again, we're talking about construction of portfolios, and one of the pieces is this active manage. And just again, to wrap this up, that's been extremely effective.
Yeah, I think you're exactly right. Being able to constantly make those subtle changes, make those subtle take advantage of drawdowns, peel off some gains when the market just keeps skyrocketing up. And then being acting on high convictions, acting on when we're bullish in energy, acting on when we are bearish in bonds, being able to take advantage of those firm-wide and not just think, you know what, I hired this mutual fund manager, I hope that he agrees with my outlook, and just sticking to the story that you've told your clients for 20 years. Being able to recognize that March of 2020 was an extremely unique situation and take advantage of that.
Yeah. Well, thank you guys. Taylor, appreciate you hosting this and moderating this. We'll be back soon for another one.
Thanks again for watching, and if you have any questions, please feel free to reach out to your advisor or give us a call at 208-955-0500. Thanks again for watching, and we'll see you next time.